Well, good afternoon, everyone. This is Gino Morrow, your current FAMP president, and I'm joined here today by Linda Knowlton, our vice president of FAMP. And I'd like to thank everyone for joining us for another webinar in our series. I want to remind everyone, that FAMP is dedicated to our members, and we are going to continue offering these webinars with updates on how this COVID-19 is affecting the industry, so that we have more information, or better informed, and can better serve our customers. So if you're not a member, make sure you join today. You will have access to not only this webinar presentation, but there's also the content that's been going out weekly, available in a library on our website for our members. And if you are a member, you'll also be receiving a recording of this presentation later on this afternoon. I do want to remind everyone, if you have any questions throughout the presentation, please go ahead and type them into the chat box. Linda will be monitoring these through the presentation. We'll break for a moment somewhere in the middle and get your questions answered, and then we'll wrap up the presentation. So at this point, I'm going to turn it over to Linda so she can introduce our panelists today. So Linda, go ahead, take it away.
All right, thank you, Gino, very much. So again, welcome everyone for attending our wonderful webinar today, and it is sponsored and presented by CIC Credit. We have four gentlemen that are going to be panelists and presenters today. Eric Wimsatt of CIC Credit, he is the National Sales Director. We also are honored to have Mike Thomas, the CIC Credit Chief Operating Officer of WDME Inc., and also Vice President of Operations of CIC Credit. In addition to those two panelists, we have two presenters. And our first presenter will be Tim McQuillan, which is from Credit Expert Inc., the channel manager. He assists mortgage companies, banks, and credit providers to help them get the most from Credit Expert tools and resources. And lastly, and kind of our most important, is Jason Dickinson of CIC Credit, Senior Account Executive. Jason was very instrumental in putting this together for us today. He's also a strong FAMP supporter, having been State Affiliate of the Year in 2016, and also formal FAMP Broward Chapter Affiliate of the Year. So again, I welcome all of the gentlemen today from CIC Credit and Credit Expert. And Jason, take it away.
Thank you, Linda. Thank you, Gino, also. Good hearing from you guys, and I look forward to this. Thank you to everyone for joining this call today. We really appreciate it, and we know this is a very relevant topic due to the current events that have occurred over the past couple of months with COVID-19 and its economic impact. I am Jason Dickinson with CIC Credit, Senior Account Executive. I've been with CIC Credit since 2005. And been a member of FAMP for 9 years. FAMP does a great job of providing excellent information to mortgage professionals, and I'm sure many of you are members. If you're not, I would highly recommend you becoming a member of FAMP. On this call, I was going to introduce everyone, but Linda did an outstanding job with that, so I appreciate it. I will talk about the CARES Act and a market overview about forbearances and some insight on the effect that it has on the credit report, and potential solutions that can assist you, the mortgage professional. Then Tim McQuillan with Credit Expert will offer new ways to help qualify consumers, which is really needed right now more than ever, with the general need for higher FICO scores in today's market. We'll skip over that. We've been over everyone. So today we will be talking about the forbearances reported to the Credit Bureau, how they can affect the credit report in regards to score, which I know everyone wants to know about that, the underwriting and more. Seems to be constantly changing as improvements seem to be being made for forbearance policies and how they're handled, and new products coming to the market. We've got new products coming to the market in the last few days, 3 or 4 of them alone. CIC Credit now has a free tool to assist that we'll also discuss later in the presentation. As recently as Tuesday, May 19th, a positive change was made, which we'll go over, and I will be presenting the information we know, as of today, May 21st. And a little bit, CIC Credit is a credit reporting agency reseller. We're not offering financial or lending advice everyone should rely on resources like the CFPB, lenders, and other sources for professional advice pertaining to the specific situation in your case. So we'll jump right into the content. The CARES Act stands for the Coronavirus Aid, Relief, and Economic Security Act, was signed into law March 27th, 2020. It includes many sections to help Americans, and one of them includes sections on deferral of mortgage payments. By late April, early May, there was almost 4 million mortgage loans in forbearance, which is almost 8% of mortgages. And recently, I think today I heard somewhere around the number of people in forbearance is 4.7 million. So before the COVID-19 economic impact, there were about 0.25% in forbearance. So I'll repeat that. It was 0.25% in forbearance, and now it's almost 8, maybe more than 8% of mortgages are showing as in forbearance. Interesting to note, as we're beginning to see some people apply for a mortgage forbearance when they really didn't need to, or even went into forbearance without knowing it. Many people, or some of the people, have continued to make the payments, even if it's showing a forbearance. And as a reminder, just to break down the very basics, because I've been asked this a few times in the past week, a lot of people, weren't very familiar with forbearance before the past couple of weeks. I'll just go over a quick definition. A forbearance is a temporary postponement of mortgage payments. It is given to a borrower who is facing a short-term hardship. The missed monthly mortgage payments are always expected to be paid back at some point in the future through various means, either through full reinstatement of the loan, a lump sum payment of missed payments, or through a repayment plan, depending on the lender or servicer's policy. So a lender can report a forbearance to the credit bureaus, agree not to report any missed or late payments, and we will get into whether the forbearance language negatively affects the score or not in a moment, and other effects the forbearance language can have on the lending process. As we talked about, the CARES Act includes mortgage payment forbearance option, pause in payments if needed, up to 180 days, which can be potentially extended. So there are concerns of the forbearance reporting on the credit report, obviously. On May 13th, which is just 8 days ago, but it seems like an eternity when it comes to this, NAM, the National Association of Mortgage Brokers, wrote a Senate Banking Committee to discuss the negative impact consumers can have. And the good news is on May 19th, some of these have been rectified. So some concerns merely inquiring about the forbearance or deferment has sometimes triggered the place in forbearance. So the borrower might contact the mortgage company to ask about it, and it just got reported to the credit bureau. So that's a huge concern. Their comments, forbearance, deferment, or impacted by natural or declared disaster could impact or make the person not be able to get a refinance, maybe not be able to purchase just by that language being on there. But it appears, as I'll go over on the next slide, that that's been rectified. Another concern is if a consumer is wishing to exit deferment, the language might stay on the credit report when it should be removed. Other concerns we've had is that each creditor can report it slightly differently how they report the forbearance info. Like I said before, some report the information as a forbearance, some report it as deferred, others report it as a natural or declared disaster, which can lead to confusion sometimes. And I will show an example of what the credit report looks like when it shows the forbearance on there very soon in the webinar. Just a couple slides, I'll show you exactly what it looks like when you look at the credit report. So some of the concerns got rectified 2 days ago, May 19th. The Federal Housing Finance Agency, FHFA, announced that Fannie Mae and Freddie Mac have issued temporary guidance, and essentially borrowers are eligible to refinance or buy a new home if they are current on their mortgage. So if they're in forbearance but continue to make their mortgage payments or reinstated their mortgage, borrowers are eligible to refinance or buy a new home 3 months after their forbearance ends, and they have made 3 consecutive payments under their repayment plan. So this was good news that came out just 2 days ago. You may want to look at the announcement for further details. There was a little bit more on there, so you may want to look at that and talk to everyone regarding that. So this slide, I think you'll find on the top portion of this slide very interesting. This shows a snippet of what the mortgage credit report trade line will look like to the MLO when an account is in forbearance. Some of you have already seen this on the credit report you've ordered recently. If you haven't seen this, this should be very helpful to the MLO to know what to expect when you order a credit report that has a forbearance on it. You can see the verbiage in this specific example of account in forbearance, payment deferred. It could also say natural disaster or declared disaster, depending on how the creditor reports it to the bureaus. You see no late payments are shown, and the status on the right shows as agreed. The information below that is helpful information from the CFPB that you may want to view or share with your borrowers. This is for homeowners regarding up-to-date housing assistance information. We can share this and other helpful resources with you after the presentation if you'd like us to. The next slide, I'd like to pass over to Tim McQuillan with Credit Expert to talk about the score impact of the forbearance on the credit report.
Okay, thanks, Jason. Thanks so much for that info. It's very important and timely. One of the other pieces of the puzzle that I'm sure you all are curious about is whether or not the comment of forbearance impacts the score on those score models that are used in mortgage. And the good news on that is it does not. So this is a comment just like anything else. If it was a natural disaster or some type of, again, the term comment means the fact that the comment's on there does not impact the score. So that's a good thing. But what's important is the most recent payment you made before it went into forbearance. So if the consumer couldn't make the last payment before going into forbearance, then that negative event would stay on the file throughout the forbearance. So that can be problematic. So of course, naturally, now more than ever, you want to make that payment up until the time you go on forbearance, if it's possible. And of course, the ideal thing to do is to not miss, to even continue, and you can certainly continue to make payments even when it's in forbearance, and the creditor will report those. And then just the last thing I would add is that it's not like the trade is excluded from the score model when it's in forbearance. Again, it's just a comment. All the other factors in the trade, the type of account, the length it's been on the file, all that stuff still impacts your score. So anyway, just that's the bottom line on score impact of being in forbearance.
Thank you, Tim. Yeah, thank you. I think a lot of people have questions about that, so hopefully that helps solve or answer that question that people might have had. So
sure,
we do. Are you there? Hopefully everyone can still hear me.
Yep, sure.
The next slide, there are solutions. People have questions when there's a forbearance on there. They want more details. They want to know if it's still in forbearance or not, maybe get more information. There are some solutions to verify this that your credit reporting agency can help. And as with anything you do as an MLO or a mortgage company, you want to check with your underwriter, your lender, your company policy on if you need to further verify something on a credit report. Find out, for your specific situation, which solution works for you. A supplement may be requested by your mortgage company from your credit reporting agency, from CIT Credit or other, to verify or further verify details of the forbearances that are reported. Typically, a conference call with the borrower, the creditor, CRA may be required to verify the information. Maybe a rapid rescore works. Maybe it could be attempted to correct information if it's errantly reported to the bureau. The bureaus do require very specific language on the mortgage creditor to it, forbearance or deferment language actually should be removed. The credit report changed. We've seen recently that this can be a little difficult to get the language on a letter worded that way, the way that the bureaus like it. The creditors sometimes don't supply those letters the way that the bureaus would prefer. And honestly, I've also seen some clients, some mortgage companies that have, if they have time, to have the borrower contact the mortgage servicer and get the correct information reported to the bureaus, and then repull the credit report when they know the mortgage company has reported it correctly to the bureaus. That's just something that may be helpful for you. This next slide is about trended data, which is already on your credit report. I'm going to ask Eric Wimsatt to talk a little bit about this information if he could, and just maybe it could be a helpful tool for you that's on your report. Eric, if you could chat briefly about this.
Yeah, thanks, Jason. I appreciate it. We've had some experiences here recently with the forbearance information coming over on the credit report, as you know. And we've seen some information here coming back on your trended data that's displaying on your credit report. Some of our customers have layouts in which this particular data will be either suppressed or it can be toggled to display or not display. And we've seen where this can be beneficial. I don't know if it's very pertinent to some, but I know that some of the ones that we've seen, it was pertinent to be able to identify the historical payment schedule that was being made. That was beneficial to them in that they could have something for DTI. And I know that by doing this, by displaying your trended data, you could in fact see here the scheduled payment, the actual payment, and the balance over the course of the loan. Because when you keep in mind, when this foreclosure or this forbearance comes in and it's reporting that way, your payment will be showing as zero, obviously. So this may be pertinent to some of you. So you may want to make sure that you have your trended data perhaps turned on so you can see it where it can display. So that may be something you guys could train your eyes to look for in the event that you do see these forbearances or deferred payments.
Thank you. And one note about that too, a lot of people on the credit report, the trended data has been there for 2 or 3 years now. It's required by Fannie Mae if you're a conventional, if you do conventional loans with Fannie and Freddie. A lot of people decided to hide that information on their credit report. So you may, at this point, you may want to unhide it, or you can unhide it on certain reports, or not be able to look at it if it's too much information. So just FYI. So there are some new solutions. It seems the new solutions are being made on a daily basis by the bureaus and by companies and vendor relationships that we have. We do have a few of them already out, and we also have a few that look like they may be in the pipeline coming up. We do have a free service that we have active now. We can activate on your CIC credit reports with credit attributes regarding the forbearance information. We're still getting new information. I got new information about this just a few minutes before the call started, so I don't have all the details, but it can be very helpful just as another section on your credit report to indicate information about this. A pretty exciting tool I think we have is CIC Credit UDN service, or undisclosed debt notification. It's a service, it's a current tool available that notifies your mortgage company of changes that have occurred after you order the credit report and during the loan process. I think this will be very helpful, as the forbearance information will soon be added as an attribute. It notifies your company typically within 24 hours if new actions that could negatively affect your loan, such as late payments, collections, new accounts, new inquiries, significant balance increases occurred since you pulled the credit report. So soon we hope to have forbearance as an item that would be included in the UDN service. So if a forbearance is reported during the loan process after you order the credit report, you'll be notified quickly within about 24 hours regarding it. I think that will be very helpful to mortgage companies. And finally, if you're in the pre-qualification stage of the loan process, you may decide a soft inquiry pre-qualification credit report is what you want to order to see if there's any trade line, if it's in forbearance or deferment. You still get the same mortgage FICO score model version as the hard pulls. You see all the trade lines. There's no hard inquiry reported to the soft pull, so it doesn't hurt the borrower's score. To pull the soft pre-qual credit report, And then as an added bonus, you can avoid the trigger leads that you may be affected by. So you can order the soft pre-qual report from all three bureaus from CIC Credit. This could be an inexpensive way for you to pre-qualify your borrower to see if they're eligible for a mortgage before you pull the hard pull credit report. Let me go on to the next one. At this point, we will take a few questions if there are any. And before I do that, I do just want to say one thing, take 20 seconds, just, before I get into the questions, I want to thank everyone who dialed in. This call is, I know you care greatly about this industry and helping American people get better mortgage rates, move into new houses. Seems like there's always a new challenge presented to the mortgage industry. And I know you joined this webinar just to educate yourself because you care deeply about the mortgage industry and the borrowers. We're in this together, and hopefully this will be helpful information for you. So on behalf of CIC Credit and Credit Expert and FAMP, just want to thank you for your dedication to the industry. And on that, just let us know if you have any questions about the forbearance information, and we'll try to help answer them as best we can.
Okay, Jason, thank you. We do have a few questions that we can shoot at you now, and then if we have time at the end, we'll do that as well because they are coming in. So you guys tell me, how many you want here. So here's our first one. If there is a late pay just before forbearance and it is the last rating shown on the account, will it still have the same seasoning as if there was not a forbearance?
This is Tim. I would suspect it would. It would continue to report late, and in that case, assuming the consumer didn't make the next payment or the payment after that because they can't, then that would continue to age. So it would be 30 days late, 60 days late, 90 days late. The last payment status would just continue to stay late.
I would agree with that, Tim.
Okay, all right. There was, here's another question. There was one of the attendees was under the impression from Freddie Mac that forbearance comments were not going to be included on the credit report. Is that inaccurate? Because you indicated that they were, right? Natural disaster and so forth.
This is Mike Thomas here. We're seeing a ton of those comments coming across for those loans going into forbearance. Whether, I can't speak to Freddie Mac or Fannie Mae or their guidance thereof, but as a reporting comes from the lenders through the credit reporting systems, there's a certain format, it's called Metro 2 formatting. And those comments are coming across once those trade lines are moved into a deferment, natural disaster, or forbearance in this case. So regardless of what Fannie and Freddie has their guidance, I don't think it has any effect or on the lenders and the reporting that's been in place for years before COVID-19.
Okay, all right. So here's another question. Do you know if the FICO 10 changes are still slated to be activated in the summer, or has this been delayed due to COVID?
This is Tim. I could maybe comment on that. I don't think there's been any delay due to COVID, but I did recall hearing something about a delay very early this year. I'm not sure. I don't suspect there'll be much of an update this year, given everything else that's happened. But I don't have anything official on that.
Okay. Do you guys want a couple more, or do you want to move on to the presentation? Because we have many that I can go through and wait, or I can throw you a couple more questions.
Yeah, we can take a couple more.
Okay. It says, I have a borrower who applied for the forbearance. It was 10 days past the 15th of the month cutoff, and then paid the mortgage and called to remove the forbearance. Are we looking at 3 times, looking at on-time payments, or is it possibly, will it not be reported, I guess is what the question is. So paid the payment after the 15th, requested forbearance, and then requested it to be removed. That makes sense?
Yeah, so as long as the payment wasn't reported late, then there's no impact on their score, and the comment should be removed. in that
If the
case.
comments were removed, this is Mike here, Tim. I think if the comments were removed because it was such a short period of time, in this instance, I don't think that you would have the requirement of the 90 days of three, the three payments or 90 days of payments after the forbearance comment, because the forbearance comment would just be strictly removed. So I think they're safe to not have to wait 90 days for payments in this particular case.
Okay.
Yeah,
Okay.
and I would just add to that, the one, as I understand it, the Fannie Mae rule is even if you went into forbearance, if you made your payments during that time, you don't have to wait.
Correct.
Okay.
If it was delayed, then that's only waiting period. If there was a true 30-day window of no payments, then you would have to wait your 90 days with payments.
Right. That's right.
All right. Okay. That's great. That was a tough answer there. You guys did it. How about credit cards? You guys, it was a good team effort there. How about credit cards and forbearance, where credit card companies are allowing forbearance? How is that being reported?
Do you want to comment on that, Mike, or do you want me to?
I can. They're doing it no different. So you have educational accounts, student loans, mortgage trades, revolving, open trades, a lot of different categorizations of trade lines, including credit cards, which is a revolving, can report forbearance, natural disaster, or a deferred payment. So they can do that under CARES, and those will be put in forbearance. And I believe, from my understanding of it, the same rules will apply. If it was late prior to forbearance and the lates would stack up, like Tim mentioned earlier, and if it was on time, and then it would just be frozen in time until the forbearance, deferment, or natural disaster is removed, and payments are resuming as normal.
Okay, so that there was the next question about auto payments as well. So credit cards, auto payments, and any type of revolving type of credit, you think is as you just indicated, under the same umbrella, if you will?
I believe so, yes.
Okay.
Hi, this
All
is
right.
Jason. I saw auto loan in forbearance or deferment today. So yeah.
Okay. Okay. How long will it take to take off the forbearance from the credit report if forbearance was never exercised? In other words, they called in, requested forbearance, but never follow through with it or exercised it.
Jason or Eric, y'all can take this.
Yeah, I've seen it, honestly. I had a situation where they just had they had the borrower contact the mortgage company, and that mortgage company reported it, changed that very quickly within a few days, and the LO just pulled a new report and it wasn't gone. Another person said they called the mortgage company, and the mortgage company said they would report that the next time. They just missed the reporting cycle. They would wait, about 30 days for it to be reported. So it can vary by creditor.
Okay.
I don't know. You guys may want to add to that.
All right. Go ahead, Eric.
This is going to reflect back on a rapid rescore, is what we call it. Just give you some insight on one that we just did recently. We had one that came through with the verbiage of forbearance. The customer went and got the letter from the creditor saying it was no longer in forbearance. We did the rescore, sent it up to the bureaus. The creditor then replaced the forbearance comment with a deferred comment. We've never seen that. That was new to us. That being said, they had to go back to the creditor, request a letter saying that it was no longer in deferment. The bureaus are really particular about what they want to have these things removed. We had to do a second rescore to have the deferment payment status removed. Once that happened, came through, all was cleared, payment was filtered back in as well. In this scenario, I did call the bureaus themselves to try to get some input and some guidance on this particular instance, because we've never seen it, with the comment being replaced. They indicated to me that we should advise our customers that when we're getting these, when your customers are getting these letters from the creditors, that they include both comments, both forbearance and deferred to be removed, trying to cover both bases in the event that that happens in the future. So that was something that we got to see firsthand, which was new to us. And so that's kind of the first thing that we've seen in terms of the rescore goes. And that being said, it was done in 2 or 3 days.
Okay, well, that's encouraging for sure.
Yeah.
You know, there seems to be a lot of, as I'm reading through these questions here, there seems to be the several questions on clarifying how forbearance affects or impacts the credit scores. Do you mind just maybe recapping that? I know it was in the presentation earlier, but it seems to be that we need a further clarification on that, or maybe reiterate.
Sure. No, it's a good question. And because it's a comment only, it has no impact on the scores that are used in mortgage, the FICO scores that are primarily used in mortgage today. So if it's in or out of forbearance, that comment in itself does not impact the score. What does or could impact the score, obviously, is if you cannot make your payment and you don't, and then you go into forbearance, then that late stays on the file and can drag you down over time, as well as immediately.
Okay. All right. Here's another one. I'm hearing that student loans have automatically been placed in forbearance by the lender without the borrower requesting forbearance. How do we handle this, and how does that impact the score?
Yeah, good question. And that's what was happening. And that's why I think there's so many, not just mortgages, but other loans that are in forbearance, is because it was, this is kind of like if some localized act of God event occurred, and a lot of people in that local area would have a forbearance capability. But in this case, there's just a massive number because it's a global pandemic. So, a lot of files were just automatically put on it instead of all these consumers waiting in a phone queue to call and say the same thing. Some of the larger issuers just said, let's just put everybody in forbearance right now. We still want them to make their payments, so obviously you still make your payments. Again, it's just a comment, so it wouldn't have an impact. I hope that answers the question.
Thank you. Yeah, I think it does. I think that's a good clarification. So it looks like we're wrapping up the end of the questions as what you've covered so far. So if you want to move forward, as they come in, I will we'll have some more for at the end if we have time.
Okay, great.
Okay. So yeah, Tim McQuillan with Credit Expert, if you could take over and talk to us about Credit Expert and how it can help us. Thank you.
Okay, great. Yeah, I want to hit on 2 of these things, tools, and then first, though, a unique market insight. So if we would advance the slide, please, and talk a little bit about what we're seeing. We have kind of a unique perspective here at Credit Expert where we see the credit pulls that are in connection with origination. And we expected in April to see more people with higher scores applying for loans as a percentage, because that's kind of the narrative that was out there. And it turns out to be true. As you can see, the red line is higher as a percentage of the credit pulls for origination are in the higher score range. But what I've got shaded in blue there is kind of that area between 700 and 640, which was, typically in the past, if you had a 640 or higher, you were pretty good, you were pretty qualified. And what we found in March is 24% of the people, or the files, I should say, were in that area where now they had to get a higher score to qualify for the same loan program. We know there's other requirements that were increased, like cash for down payment and DTI levels, but score as well is one of the things that have been increased. So then we ran the numbers again in April, and we can see there's a lift. So now 28% of the population in April needed that additional score increase. So anyway, the point is, a lot more people need a lot more of a score increase to qualify for the same loan program they may have qualified for back in February. So I just wanted to share that with you, and then talk a little bit about the tools, the first being Credit Expert Wayfinder, and share how this tool, because some folks, if you could advance please, some folks may be newly getting familiar with this idea of helping consumers improve their score, because like I said in the earlier slide, more consumers will need it. Well, the good news is Wayfinder was put in the market about a year ago to help make it really easy for people to find a score improvement program for your consumer. So if you could advance the slide, please. In this case, we're selecting a bureau, and then advance again, sorry, and select a score target. And then if you could advance it, please. One more time.
Did that advance? Okay.
Yeah, there you go. So in this case, we quickly found a plan. A way to get over 640 was the target score. I'm kind of dating my presentation by showing this from 640 being the target. But anyway, the point is, whatever number you pick, it quickly tells you how likely the plan is and how much cash the consumer needs and how many actions they need to do. And then as I look down, I can see exactly what the plan is. Very consumer-friendly language, very simple, very easy to understand, but specific instructions. And even to the right there in the gray area where it says avoid other changes, kind of reinforcing some of the things that you've been saying to your customers, do this and don't do that type of instruction. So another component of this capability is you might need a higher score increase. So in this case, we went in and said, well, what about 660? And the tool did find a plan. It was 80-something% likely, and there was a little blue prompt, little blue prompt there to the right that asks if you'd like a more likely way. And again, trying to make things easy for you guys to use, because this stuff can be pretty complicated. By clicking on that blue box, if you can advance the slide, the prompt appears that indicates, okay, here's a higher likely plan that requires less money, but a little more time. So you can click through and find out what that plan is, and again, give it to your consumer, and you're good to go. We could just advance it, Jason, twice, I think. There you go. Great, thank you. That's it. So this is the plan where they wait a month, and it's only one pay down of $50, and canceling your access as an authorized user. So, also higher score increases are needed, and people tend to have less cash in these types of environments. So you might find plans that require less of it. And then one last thing I wanted to share with you is this little feature where there's a score drop warning, because sometimes time can hurt a file. And in this case, we're just prompting you that there's a potential for this happening in the future. That little yellow banner says that. And then the prompt offers you two choices. You can either change the time frame to go onto 1 month, and we'll try to offset that score drop, or you can say, okay, I get it, I'm going to do a rescore right away, and the expectation has been set with me and my customer. So digging into this a little bit more, if you don't mind, with What If Simulator, this tool allows you to simulate a complex combination of actions or simply age the account into the future. And I'm going to drill down a little bit more here on some examples. Oh, that's good, Jason, thanks. So in this case, what we're looking at is all the trades on this particular file. We currently have a 631, and let's say it's a case where we need a score improvement. We don't have much money. So the first trade here shown is a collection account. This is a non-bank third-party collection account. And what I want to do is say, what if I deleted that? If I called the agency and had them delete it for a full or partial payment, might they do that? What's the score impact of that? So go ahead and click the next slide. In this case, the score improvement is the same. So I can get it deleted. You can tell it's deleted because of the orange text there. And this was a good try. Sometimes this does help, sometimes it doesn't. The thing that's important on these non-bank collection accounts is how many are on the file and when it came to the file. So it's just the presence of it. So really deleting it is the key. Paying it down doesn't have an impact. And then here's another way. Again, I'm still trying to get a score improvement without any cash. So I did find a way here. A few trades down, we see these authorized user accounts. So the consumer, this could happen, and you get put on as an authorized user. few years go by, you forget about it. The credit balance has gone up. I'm sorry, the balance has gone up. And in this case, they're 97, 93% utilized. So why not just simulate deleting those two accounts, taking them off the file, and now we've got a great plan to get over 670. And then the last one is aging. So if you see that little area to the right there, the white box, the right of the 647 number, it says in 5 months. And what we're doing there is saying, okay, what if this consumer just aged it out? Sometimes time can help, and making the regular payments on time, and that's the plan basically in this example. I'm sorry, I had one more feature to show you. No, that was right, Jason, sorry. You had it, there you go. So one of the things that's also kind of a phenomena of the current environment is rescores might be taking longer than usual. And you can check when the creditor last reported the natural reporting cycle by clicking on that little date in the open column just to the right of where it says authorized user on this particular trade. But on any trade where it says the open date, you click on that and a little black box appears that indicates when the creditor last reported. So if they just reported 3 weeks ago, and I see they report pretty consistently, instead of doing a rapid rescore, I just probably want to wait another week or so when they re-report. So if the consumer had made a payment or something else is about to the file, that's a beneficial thing, you might as well, again, just wait for it to re-report. Again, this is kind of a phenomenon because of what's happening today when, just things that are manual and process have tended to slow down a bit because of the new working environment. And that's it. There's more tips available on our website, and I really just kind of like what Jason was saying earlier. We sincerely believe this stuff is about the consumer, and it's about helping you guys get the maximize the relationship you have with them, and avoid a lot of the noise and a lot of problems out there and people in their dream home. So we've put a lot of tips and even scripts and detailed information online at this website, because we've met with some of the other peers and they've given us, frankly, ideas and suggestions on best practices, and those are available online for you to take a look at. So, and that's with respect to using the tools as well as the conversations with the consumers, that go in regards to these explaining the plans and following up with them on how they're doing and completing the plans. So good stuff. Here's a link to those resources, and I think we're going to send out a PDF or there'll be some way for you guys to get those links. But I'll let you take it from there, Jason, and maybe you have some more questions.
Thank you, Tim. Thank you very much. I always love the what if simulator and Wayfinder, so I really appreciate that. Linda, are there other burning questions that have popped up, or?
Yes, we have. We have a few for you guys. So I will, as time allows, I will shout them out, and whoever wants or needs to answer them, you guys just take it away. So here's one. Are you seeing issues with the automated approvals accepting the code for the forbearance?
Eric or Mike, have you heard about this? Or
I have not seen anything that would cause any issues with codes. No,
I have not either.
Okay, well, that's good news. That's good, really good news. Okay, here's another one. Is taking an older collection, paying it off adversely, does it adversely affect the credit score, or will it fix the flaw? So some of these questions are relating to any type of credit question. So, and that would be one of them.
Right, sure, no problem. Yeah, we get this a fair amount. The real key on the collection is whether it is a non-bank third-party collection, like from a collection agency. The answer to that question is paying it off does not impact the score. The only thing that matters on those types of collections is how many of them are reported and when they were reported. So no is the short answer.
Okay. Okay. When you say delete from the file, how does that work?
Okay, so I think this is in reference to an authorized user I'm talking about I'm talking about removing yourself as an account holder. So if I'm on an account with my wife and I want to be deleted from it, I would contact the credit card company and ask to be deleted, removed from the account. Yeah.
Okay. Okay, so
It's
do
just,
they need to do that in writing, or how's that typically done?
I believe it's typically done in writing, or you can call and then they'll give you a confirmation that it's been done. But the key there is that the term deleted is used. Some of the things that happen with authorized user is your status is not deleted, instead it's terminated. It's a little bit different. So that's why we keep using that term deleted, and that's in all the instructions and the output of our tools that you'll see. It's just, again, a good kind of working language to use when we're talking about this stuff.
Okay. Here's another question. Are you seeing any impact in rapid rescores? Are there any impact on the credit score once updating? In other words, is there any long-term impact on the rapid rescores to the credit scores?
You mean in relation to the forbearance, deferment, or natural disaster?
I think I would answer that both ways. Maybe yes with that, and then in general.
Tim, you wanna talk about the score effect?
I guess just in general, a rescore expedites that update process is all it does. As you probably know, scores are a snapshot point in time. So if I pay down a balance and I want the credit file to reflect that balance immediately, or as soon as possible, I should say, not immediately, then I would look for a rapid rescore. I would, and if I wanted to just wait, or if I was okay with just waiting until that creditor reported again, they might report every 4 weeks, they might report once a quarter, then I would wait. I would not do a rapid rescore. But again, once the rapid rescore is done, the next day, if the creditor reports something else, that new something else is going to be considered in the score as well.
Okay. All right, here's another question, again, a general question. How many points differ between a CIC credit report or other credit reports and consumer credit reports, such as like Credit Karma and others that are consumer credit reports?
Yeah, I know what they mean by that. I want to say it's more than 5 or 10, but there's no real hard and fast number on that. It's usually higher. The consumer, the score they get on a consumer website is usually higher than the score from a mortgage credit pull.
It really comes down to the mortgage credit pulls are all using scores from 15 plus years ago. And score advancements have exponentially increased over that time period. We're using 04 models and various models back in the early 2000s as what underwriting was based on. So Credit Karma and those type of companies out there, even Experian, if you go have their Experian Boost app on your phone, it usually base your score on Experian FICO 08. And a lot of those are very robust, strong scoring score models that take in consideration alternative trade lines, utility payments, etc., and takes away any weight on an authorized users, referring back to a previous question. But again, that's really the difference between the two. Like Tim said, it could be much higher or much lower. It is really comparing apples to oranges when you're comparing a 15-year-old model that the industry is built on to a more robust new model that takes in consideration, alternative creditors, removing authorized users, taking less weight onto medical debt, etc.
Okay. All right. I think we're wrapping up the rest of our questions that are coming in. one of the things that's popping up here frequently is, yes, there will be the presentation that will be sent to everyone, as Gino had indicated in the beginning. So, and I think that's wonderful for all of you, that everyone is just really enjoying this information and much needed information. But I have a question for any of you. If you, where we are today and where we will be possibly in 6 months, and this is kind of in the future type of question. Do you feel like the long-term effect on forbearance in 6 months to 12 months after this is all gone, is that going to have not a permanent, but have a negative impact on the long-term credit reporting of these forbearance?
It's a good question, Linda. I don't know about the others, but I know, I can only go back to another situation that a lot of people remember in 2008, 2010, when a lot of people had foreclosures or short sales, and it was a big deal, and it was confusing how it was reported to the credit reports, and this may have the similar impact, and it may not. It's hard to tell. But in time, everything gets cleared up and corrected, or viewed, and we'll see. No one has a really good answer though.
Only time will tell on that one, that's for sure. So
I believe, Jason, I believe you and Linda are correct, Jason. It's a time will tell situation, because there could be regulations, acts. We don't know what's going to happen in the future. Congress could make changes. The CFPB could put regulations in, or different regs and to require certain things. So again, it's one of those. It's hard to tell.
Okay.
Yeah.
All right. Well, this has been absolutely incredible. And Jason or Mike or Eric or Tim, are there any final words that you'd like to say to our audience before we wrap it up with Gino?
No, just amazing questions. Thank you so much. I see most people have stayed on the call the whole time, and those were very intelligent and great questions. So thank you so much, and reach out to us if you guys have any other questions at all.
All right, Jason, Eric, Mike, and Tim, I really want to thank you for bringing the updates to everyone on the call today. We know this is such a hot topic because, frankly, it's a moving target, and I know that some of what was discussed today is fluid, and it may continue to change. And I want to point out to everyone that not only has CIC Credit been a longtime supporter of FAMP, but Jason Dickinson has worked on many FAMP committees and throughout some leadership in some of the chapters over many years. Looks young, but he's been around for a while. And he's really devoted a lot of time to our benefiting our members. If you have any questions, he means it. Don't hesitate to reach out to him. I know that they're very busy, but he is absolutely one of the most knowledgeable professionals in the credit industry that I know, and really sharp kid. I don't hesitate. I do want to point out what Linda said earlier on the recording. It is absolutely going to go out to all of our members. If you are not a member, you will receive an email sometime today with an offer to become one. Take advantage of that. There's a little promotion for you as a new member, giving you an extra couple of months with your membership. It gets you access to some of the content that may not be free. It gets you access to the library of webinars that's on the website. There's a whole slew of information out there for you, and frankly, if you're working in this industry, you absolutely should be a member of FAMP. This is the association that represents this industry, and we're here to protect our jobs and this industry and make sure everything goes forward. So with that, I want to thank everyone for being on the call today. Thank you, Linda, for going through all those questions. You guys did a great job. I would absolutely love to bring you guys back as things change, maybe in the near future. Of course, we'll see how long this is going to last and how these changes will impact us more on a long-term scale. But thank you, everyone, for being on the call. Have a great day, everyone.
Thank you all.
Much appreciated. Have a great day, everyone. Thank you.
Thank you.
Appreciate it.
Bye-bye.
Bye-bye.